On the podcast with us today is Brian Albers and Brian Taylor with Affordable Upstate LLC out of South Carolina. Looking forward to having a discussion with you two on this particular property, which is going to be the 80 unit in Clinton, South Carolina, called Landau Apartments. You guys closed this thing on November 18th earlier this year. But before we dive into that property, I would like for each one of you to kind of give us a little bit of a background about yourself and where you are right now in the multifamily space.
Sure. I'd be happy to start. I started investing in real estate in 2017. I met another partner who's not here with us today, Mario Brown, back in 2016. He was doing some single family, the Burr model, buy, rehab, rent, refinance. And at the time I was thinking I would do something similar to that, but then he told me to check out multifamily. So just did a bunch of research. At the time I was working full time at Raymond James, so I had a lot of experience with investing in stocks and bonds, but not in real estate. But I was a little nervous about doing real estate at first because of a rehab project that I had at my own home. But with Mario's experience in full-time construction, that helped me leave my fears. And we purchased a 36-unit apartment together in 2017 as our first purchase, and then followed it up with some other plexes. And this apartment is our biggest one yet.
Sure, and I can introduce myself. I'm Brian Taylor. Similar to Brian Albers, from a timeline perspective, I started investing in commercial multifamily real estate back in 2017. The way I got started was more on the LP side, so actually deploying my own capital and some of my family's capital into deals that I was interested in. That really helped me learn the process, understand the deal, understand the benefits and value that is part of multifamily investing. Since then, I've partnered with a number of folks to help out with some capital raising, to be more on the GP side. And then with this particular deal, I partnered with Brian and Mario on a variety of fronts to kind of help it get it across the finish line, and then we'll stay involved throughout the operational period as well. My background, and still I'm one of those crazy ones that still has a day job, so I'm a management consultant. I work for myself, serve clients in a variety of manners, helping them operate more efficiently. So very attuned to the operational aspects of these deals, but have a true love for investing and especially real estate.
Well, I want us to get started on this particular acquisition because I know we've been kind of discussing trying to get you on the podcast for a couple of months now. And I wanted you to first start off by talking to us about how you first came across this deal and started to actually, look at it to begin with.
Yeah, I'll take that one. I got it sent to me by a local broker here in Greenville, South Carolina. He had ended up putting it under contract with another one of his clients back in February of 2019. And after they did an initial inspection of it, the contract fell out. They were a nonprofit who really was more used to a more finished product, less deferred maintenance. And that gave us the opportunity to come in and we basically used the same terms of the contract they had already had in place, so there wasn't so much negotiating once we came in.
And so when you were first given to this in this particular project, at what point during that entire process did you guys start to actually tour it?
I took a tour back in February, but when it fell out of contract, we of course took additional tours in April, and we went into contract in early May.
Okay. And so when you toured it in February, was that at the point where it was already under contract with the other buyer?
It was, they were in negotiation still. We both submitted LOIs, and they ended up going with the other buyer initially.
And what was the reasons why they went with them versus you initially?
Yeah, they were a much bigger operation. They're a nonprofit who had a lot of experience with dealing with HUD subsidized properties. We have tenants at our existing apartments that have Section 8 housing vouchers, but we had never taken over a property that was under a HAP contract before with HUD. So they liked their experience with that over our lack of experience. But we were able to convince them that, we were going to be able to get through the process. And they were really helpful along the way with getting through all the red tape of HUD.
Mm-hmm. Yeah, to share with us on a high level, what are some of the different things that you guys experienced in this process of, the like you said, the red tape when it comes to one of these HUD type properties?
Yeah, it's really more intensive than even going through the bank loan process, getting through the HUD process, I would say. More documentation. There's probably a 25-point checklist of items that they want to see. Many of those items are, several items really. So you kind of name it in terms of any type of due diligence document you'd ever might see. We had to provide that to HUD.
And what are some of the benefits with going through that type of financing?
Well, the financing we did was just through Bellwether Enterprises, an affordable, they're Fannie Mae, Freddie Mac type lender.
Mm-hmm.
But HUD, we had to go through their process because the property has a HAP contract affiliated with it. So 75% of the units are under this HAP contract. And so it guarantees the rent for all of those units through a check that gets deposited every month into our checking account directly from HUD.
Yeah, they basically want to make sure that if you're going to take over this property, you're taking over the responsibility of maintaining it, making sure it's a good community for these folks who are under the HAP contract. And so you really just go through a pretty robust screening process to make sure, A, you're legit, B, that you're in good standing, and that you're going to take on this property and meet all of the guidelines. There's plenty of guidelines just to get us to closing, but now that we are owning the property, there's going to be additional things that we're going to have to watch out for and report back. So it's a little bit more paperwork, a little bit more scrutiny, but what we have found is that the monetary aspect of it is worth the patience that you have to endure during the due diligence period.
Mm-hmm. So with that HAP contract, is there a certain length on it, and is there a certain number of limitation on how much you could increase the rents and things like that?
Yes. So the current HAP contract was renewed 7 years ago, and there are 13 years left on it. We can renew it at any time, so we'll probably renew it early next year, mm-hmm. so that we can extend it, and it'll be 20 more years. The limitations of it are that they will, HUD has some kind of inflation metric that they use to increase rents annually. And it's just really a cost of that they calculate of just, what are things costing in terms of supplies and services. So you can use their inflation metric annually. They also allow you to hire an appraiser to do a rent study in your local area. And that can also result in maybe even more rent increases that they offer. You can only do that every 5 years, though. So that was just done on this property in April of this year. So we'll more likely just be along with inflation for the time being.
So what happens if on this kind of a property you have some major expense that comes up and you don't have the cash flows to be able to do that? Is there something in that contract that allows you to have like a special purpose, expense that you can defer to them that they actually can help pay for, so that there's not an extreme amount of deferred maintenance on the property?
Well, they require that we have PCNAs done before we purchase it, just like the lender did. So we had 2 of those performed, and we came up with a renovation budget. So they require that we, make any necessary repairs going into it before they will reassign us the HAP contract. And Otherwise, if anything came up, it would just be like owning any other real estate. They do annual physical inspections, though. So if something comes up on those inspections, we would likely be required to complete those repairs.
Okay. Where do you see the biggest risk or downside for, you and your investors in a project like this that has a HAP contract on it?
I'd say the biggest risk would be if we experience another government shutdown like we did a year ago. A couple months of a government shutdown is no big deal, but if it were to last for 6 months, something like that, we would stop receiving a major portion of the revenue from the project. But I think a lot more would be going wrong in the country at the same time.
Sure. So how do you factor in that in your underwriting when there's not an actual number that they're using for inflation, like 2% or 3% or whatever it is on the underwriting for the rent increases year over year, and it's kind of a up in the air formula on how you actually determine what those rent increases are going to be year over year?
Yeah, we tried to be pretty conservative on that. And that's kind of our philosophy always.
Yeah, I mean, Dan, you're right. You can't plug in the exact number for every year for the next, give or take 2, 3, 5 years or whatever. We looked at trailing, like what were their rental increases, because we could see all of the HAP contracts every year that they got renewed, what was the rental increases. So we have a decent idea of what to expect going in the future. As Brian mentioned, and as you preach as well, Dan, be conservative in your estimates, and hopefully you will at least hit or exceed those in the future.
Yeah. So we ended up projecting just a 2% annual increase for rents and a 2% annual increase for expenses.
Mm-hmm. Okay.
Yeah.
You said how much for expenses?
2.
Okay.
Yeah.
That's pretty standard. So how many other people, when it came back to you in May, when it came back, or I'm assuming it probably came back to you in April and you negotiated and finalized the contract in May. I'm assuming I'm coming up with stuff off the top of my head. I'm assuming that's probably what happened. And you can correct me if I'm wrong, but how many other people were bidding on it at that point, or did they just go back to you and say, hey, do you guys want it now?
I think they pretty much just came back to us because the same broker that was representing us on the buy side was also representing the other folks that fell out of contract. So he knew that we wanted it, and he just came right to us, and we went directly into contract negotiations.
What kind of earnest money did you have to put up for this one?
Just 1%, so about $25,000.
Okay. And let's talk about the due diligence process right now. So what kind of things came up during the due diligence process that maybe surprised you that you didn't necessarily know in the beginning, that maybe caused some delays or caused some extra money for either the seller or you to have to fix or complete?
Mm-hmm. We knew going into it that there was going to be some deferred maintenance. Just kind of walking through each unit, seeing some of the old water heaters or old air handlers, things like that. It was a little bit more than what we were hoping for going in, but we still had ample renovation budgets to cover it.
Yeah, I wouldn't say there was any major like building issues that we found, and some of the normal stuff that you might expect. You're always going to find some AC units or water heaters that are in need of repair. I think the GFI outlet, was a clear one. That's a pretty simple, easy thing. So nothing major in terms of, all of the roofs need to be replaced or all the parking lot needs to be redone. So we're in good shape from some of those major items, I would say.
We did have something come up when we got the approval letter from HUD, and it was, they wanted us to have the property looked at from an ADA compliance standpoint. Our PCNA that was ordered didn't completely cover ADA compliance in it, because that was something we didn't know that had to be a part of the PCNA. So we found out that with any type of HUD project, PCNAs are required to fully show how the property is in or out of compliance with ADA, and then we had to look at the rules around what improvements we had to make based on its current condition, and there are some grandfathering in type loopholes that you don't necessarily have to make all the improvements based on the age of the property and when the ADA laws were written, that we had to navigate.
Mm-hmm. What year was this property built?
1973.
1973. Okay. And so you have the inspections are happening from the lender side, the HUD side. Obviously you're using, you're probably using a third party property management company on this one. Is that correct? To do the unit walks and things like that?
That's correct. Yep.
Yeah. Okay. And, from a renovation standpoint, what's kind of the scope that you guys are looking at doing as far as trying to renovate either the interiors or exterior of this particular property?
Mm-hmm. Yeah, I can take that. I guess first of all, the way that you have to really approach this property is in two ways. One is look at the 60 units that are under the HAP contract versus the 20 units that we're calling market units, because they're available to be rented by anyone in the marketplace. So when we looked at it from a renovation perspective, we wanted to understand what qualifications we need to meet on the HUD side and make sure that those are met or exceeded, to make sure that those 60 units are in good shape. Because if you think about it, it's really it's money. A lot of the money is coming from the government, and it's more or less guaranteed, and we know exactly what we can get from a rent perspective. So there's less of a value add play on those 60 units compared to the 20 units, where we do have more flexibility in terms of the rent rates that we can get. Therefore, our renovation budget's more focused on what do we want to do from those 20 units that's going to meet the what the market is offering in terms of rental rates. And a lot of those are going to be your generic sort of flooring, countertops, paint, that type of thing. It's not going to be necessarily a gut job where we take out everything from those units and completely flip them. It's really more cosmetic and on the surface types of things that we want to do there, because this may surprise some of the listeners, but those market units are actually getting less rent income on a unit basis compared to the HAP contracted unit. So there's room to grow those rents over time because they need some facelift, if that makes sense.
And I'm sure there's also a balance of making sure that you don't over renovate the 20, because it's still going to be hard to put a higher quality tenant in 20 units that are next to maybe a lower end type of a particular unit that's under those HAP contracts. So there's definitely going to probably be a balance there where you're not over renovating, but you renovate to enough so that it kind of matches the current market and that current rate in that market.
Yeah, that's right. Yeah, and that's just in terms of your last question around what did we become aware of during due diligence. I think that was one of it, just making sure we understood the Clinton market, right? It's a small town market. It's on the peripheral of the greater Greenville, Simpsonville, Malden, Lawrence kind of MSA. So yeah, you're right. We're not trying to reposition this property by any stretch. We're just trying to make sure that it meets the needs of that local market, so that we're not expending excess capital and not getting returns on that capital.
Sure. So the 20 units, let's talk about those for just a minute. What was the in-place rents on those 20 units, and what type of units were they as far as the mix?
Excuse me. They were about $170 on average lower than the HAP contract units. Mm-hmm. So I think their in-place rents were around, you have it here, between $415 and $561 for a 1 versus 3 bedroom. Mm-hmm.
So is there just 1s and 3s, or is there some 2 beds in there as well?
There are, let's see, there's 4 1 bedrooms, 12 2 bedrooms, and 4 3 bedrooms on the 20 unit market side.
Okay. So average delta between Not necessarily the HAP contract, but the current market rents. What was that?
About $174.
Okay, so still a pretty large delta there. Now, what was the story behind that seller and them not trying to push those up as well?
Yeah, they, I guess, I'm not really sure.
Yeah, that's a good question. It's one of the things that we had to sort of ask ourselves, and we got questions from our investors as well. So I think your natural inclination is to think if it's market facing, you should be able to get good, solid rents compared to whatever the government's offering you. In this case, it just wasn't the case. Honestly, I think it was just poor management, and I think they let those 20 units go into a bit of disrepair compared to keeping up with the minimum qualifications on the HAP contracted units, because you get inspected every year. You've got to make sure those 60 are in good shape. And so I think it was just years of maybe not paying as much attention to them and then letting the rent sort of fall out of place a little bit. That's my guess. But
yeah, the owners were out-of-state owners, and they have a lot of other properties. So what probably happened is those 20 units just weren't as high of a priority for a value-add strategy as maybe some of the other low-hanging fruit in their personal markets where they live.
yeah.
What's the retention rate year over year with renewals?
There are about 20 on average people that move out every year, so it's about 75%.
Okay, that's pretty strong. Now, with the HAP contract on the 75, you're only getting paid for those units if they're occupied, right? They're not just going to write you for 75, are they?
Well, interestingly, another benefit of the HAP contract is if you have vacancy in those, the 75% of those units, they will pay you 80% of the rent during the vacancy period. And you get that in arrears when you have your property manager do some reporting via HUD systems. And the exact way it works is the clock will start ticking as soon as that unit is ready for someone to move into it. So if you take a bunch of time to do a renovation of a unit after someone vacates it, the clock doesn't start ticking. But as soon as it's listed and ready to go, you will get 80% on a pro rata basis for the number of days that it's on market.
I think it maxes at like 60 or 90 days.
60 days,
60
yeah.
days.
So you could feasibly have 2 months of getting 80% of the rent for that unit. That's a major benefit in terms of protecting your, revenue risk.
Mm-hmm. And what's the occupancy level right now on that 75%?
We have 3 out of 60 currently unoccupied, and we're just working on renovations.
How many of those 3 are HAP contracted? Do you know?
There's 5 total vacancies, so 2 of them are on the market side and 3 of them are on the HAP side.
Okay. All right. Good. Well, talk to us a little bit about what you're doing on the renovation side of things, because obviously not obvious, but is there a certain level of renovations that you're going to do on the HAP contracted units versus the more market units? Or is all the budget going into the market units?
Yeah, we'll do some property-wide exterior renovations. So some of the painting is starting to chip on the doors and the shutters. So just doing some light cosmetic updates just to give it a little bit of a facelift outside, updating some signage, improving a little bit of the landscaping, fixing replacing some of the older HVACs and water heaters, some of the mechanical components of the property. And then a majority of the rest of the renovation budget will be going towards improving those 20 market units with an LVT type flooring, new paint job, some upgraded appliances, maybe some updated cabinetry here and there.
Mm-hmm. Okay. And from the current market that this particular asset is in, the level of renovations that you're doing, are they similar to some of the other properties that you did as far as like a comp analysis on those 20 market units?
I'd say yes.
Yeah.
We're just really just trying to bring the property up to a clean, modern, safe standard. We're not trying to put in a bunch of granite countertops and high-level upgrades. This is a C-class property. We're trying to make it, a C-plus class place that, people are proud to live in, and also, it meets all the standards that HUD requires for us to keep up.
What are the qualifications for someone to be able to get a unit through HUD on this property, as far as a prospective resident?
Yeah, it's basically the same as getting a Section 8 voucher. So their income has to be, they have different brackets where it's either 50% or 80% of the median income in the county. And then the voucher will help pay for up to 30% of the people's incomes. That ratio of what they can pay versus how much they make total.
Okay. And does HUD also help to kind of promote or market or attract those types of residences for your property? Or is there something you have to do specially to actually market for those people?
Yeah, good question. So you do get a little bit of help, or certainly a decent amount of help, because the individual resident has to first apply for that voucher. And once they've applied, we're one of the few properties that are available in that general area that they push potential residents to. And I don't know exactly where it is today, but during due diligence, I think we found that there's roughly a 100-person waiting list to get into one of those HAP contracted units at our property. And so it's really just, once the government identifies this person and they're eligible for the voucher, they get pushed to one of these properties. Ours, of course, is one of those. And so it's not really advertising or marketing. It's just it's a funnel of folks that are eligible for that, those properties that are coming your way. So they really have no issues with filling those HAP units because there's such a long waiting list.
Does the resident get to choose which property they go into, or is it really because of the waiting list? Whenever one comes available, you just get what you get?
I think it's both. They can't force anyone to move anywhere, but in general, people will get, take what they can get because there is a shortage of supply of units.
Mm-hmm. That makes sense. Let's talk about the financing on this particular one. I know you mentioned it being a Fannie Mae loan. Talk to us about how that was structured and set up, and what you did for that process.
Yeah, well, that was another first for us on this project. We'd never done a property that had a HAP contract or really anything to do with HUD before, and I'd never at least done a Fannie Mae loan before. So we ended up getting a 10-year balloon, 2 years of interest only. The rate locked at 3.96 in November.
And it was, I think the purchase price of the property was 2.55. They loaned us, I think, 2.35.
2.385. So they gave us 80% loan to cost.
Yeah, which was huge, right? Because we had a decent amount of closing costs plus our renovation budget, and we're able to get financing for portions of those as well.
Yeah, the renovation budget was $350,000.
Okay. And what was the process like with Fannie Mae when it came to the HAP contract piece of it?
Yeah, they wanted to just make sure that we had all the proper approvals from Fannie Mae and that we knew exactly what they were going to require of us. Mm-hmm. And Fannie Mae wanted to, make sure that we could deliver on any requirements. Mm-hmm. So there was a little delays here and there as we had to get clarification from HUD on certain items. But ultimately, they were confident that we could do what we needed to do.
Mm-hmm. Now, being a smaller market, was it, or has it been, or is it more challenging or more expensive to have subcontractors go in and do the work because maybe they're driving from Greenville, South Carolina, or Spartanburg, or Columbia, or wherever it is. Have you experienced that at all, or are they coming in pretty close to what you've seen in some of the other properties you guys have?
Yeah, we'll have to pay a little extra mileage just for the commute of some of the vendors. We have a full-time maintenance manager on site, so he'll knock out a lot of the just day-to-day repairs, and he'll help with some of the unit turn pieces. But he'll certainly need some outside help, especially from specialists like plumbers and electricians.
Mm-hmm.
Yeah, and we've got, Brian mentioned Mario earlier, so Mario Brown is another partner on this deal who's got a lot of background experience in the construction world, and so his oversight over vendor costs, material costs, all of that is going to be huge. It's nice to have someone in your corner of the ring going back for you.
Sure, no, absolutely. That's definitely a good thing to have. One of my other questions around the financing was going to be about is there any plan for a refinance down the road? And if so, is that factored into the underwriting or what's the case with that?
Hey, good question. On this particular property, we are eligible to do a supplemental Fannie loan in the future. The big question will be, does it make financial sense to do it? Just because of the amount of legal costs and closing costs that go with that process, just to get a loan that would basically pay back our investors for their initial, down payment. So we'll be looking at that in a few years. I think if the valuation of the property is high enough, it'll be worth doing. And if it has just moved up, kind of more in line with our projections, it'll be a little bit of a closer call to make.
Mm-hmm.
Yeah. I would say generally speaking, this property, at least our strategy for the property, is more buy and hold for a long period of time. I've been involved in other deals where it's, 18, 24 months from now, like the refinance is kind of the key to unlocking a lot of the returns. But we think we're going to get such healthy cash flow that we should be in good shape, but we'll take advantage of it if there's an opportunity that makes financial sense, no doubt.
Yeah. So it's not baked into the underwriting or the analysis of the return projections or anything. So it'll just be kind of like a cherry on top if you can actually, or if you guys decide to execute that option.
Yeah. The issue we were finding with the supplemental loan scenario is that this project is just pretty low end on the Fannie side in terms of just the size of the loan. So a lot of the closing costs from a percentage basis tend to be a little higher versus, a 10 million plus type property.
Yeah, no, that definitely makes sense. Well, let's talk about how you structure this deal with investors. So it sounds to me like you have a few investors into this project. How much were you looking to raise? How many investors did you have? Kind of talk us through that process.
Yeah, I'll take that. So it's a fairly typical syndication deal. So the purchase price was 2.55 when all said and done in terms of closing costs, renovations, and so forth. It was right around $3.1 million in terms of total capitalization. So based on our loan and everything, we had to come up with a roughly, I think it ended up being $740,000, give or take.
$755.
$755. So we had some last minute expenses come through. So that was our total equity raise. We syndicated the deal, and we're able to bring in, I think, anywhere between 8 and 10 investors that helped us raise that equity. And we're doing a traditional, 65-35 split on the profits. No preferred return or anything like that. I think we're going to get, healthy cash flows from the profits that will pay out in a quarterly fashion. But nothing too crazy from a syndication structure perspective. But that's how we structured it.
Mm-hmm. Now, do you typically invest alongside the investors in your projects? And if so, did you do that in this particular project?
Yes, we had the folks that make up the general partnership also had personal capital as part of that investment pool as well, myself included.
Okay. I think that's very important for a lot of different reasons for, alignment of interest and things like that. So glad to see you guys doing that piece of it. From a return standpoint or from a distribution standpoint, you said you guys do quarterly distributions. Is that correct?
Yep.
And is that starting after the first 6 months, 9 months, a year, or is it starting after your first couple of months in and you're going to start doing it on a regular basis from a quarterly standpoint?
Yeah, we're going to start right away. And we closed November 18th, so we're going to do a prorated distribution for the end of this quarter or calendar year for about a month and a half, give or take. That'll pay out in January, and then we'll start the routine in 2020 with quarterly distributions. Again, this deal is less of a, it's not going to suck up a ton of OpEx or CapEx in the beginning for renovations. It's going to be healthy cash flow from the start. So we're happy to pay out investors from the start.
Mm-hmm. When it comes to the preferred return, not doing the preferred return, what was your thought process in not having a preferred return there, and also taking more of the whole piece of the pie away from investors? Because usually I'll see if he doesn't have a preferred return, the investors actually get a larger piece of the pie to kind of balance that out, because when there's no preferred return, the highest risk is now on the investor versus the sponsorship team.
Yeah, we just wanted to keep it simple, and we backed into the returns just using the pro forma. So, we felt like we got a good value on this deal from where we bought it, and if we can get investors, high teen IRRs, that's how we backed into the equity splits.
Yeah, I think we raised, if not all of our money, within 48 hours, something like that. So it was, at least from the current investors that we have, it was attractive to them, and that's kind of what we aim for from the start.
Sure. Well, and that's as I do interviews on this podcast, that's one thing that I find is that if you are finding your own investors and you're cultivating and training them the way you're going to be putting deals together, when you actually have a deal like that to present to them, they usually, as long as those returns are there, then they'll be fine with that. So I had an investor that I interviewed, I think 2 or 3 podcast episodes ago, and his whole process was they just came in as almost like, mezz debt investors. And so they came in at like a, 6% or 7%, return on an annualized basis. But then when there's a capital event, once they achieve 12%, they're completely out of the project. There's no preferred returns. There's no nothing. It's just, he gets to keep the entire project after like 2 years after completing renovations. And then he gets a property he paid nothing for, just sweat equity and, managing the investment. And then his investors get their 12% that they were expecting from the beginning, and it's done, My investors wouldn't like that, but
what's his name?
Say again?
Yeah. That I wouldn't mind that. What's his name?
So,
and I think the other thing, go ahead.
No, I was just say it just depends on your investor's appetite and what they're looking for, because every investor is a little bit different on what they're looking at.
Yeah. And I think with this particular deal size being smaller for what most syndications are, the market is a little bit more inefficient, and you might be able to find deals that have a little bit higher IRR projections than if it were a bigger one where there was a lot more institutional competition.
Yeah, no, I definitely agree with that. What was the cap rate this one was purchased at?
8.3.
8.3. And what was the exit cap?
We used 7.5.
7.5. And that was on a 5-year hold?
Yes.
Okay. I know you had mentioned it being more of like a buy and hold, but you always have to base that number off of something. So.
Right. And it ended up appraising at a 6.3 cap. So that was a nice story to be able to tell the investors.
Wow. What was kind of the other comps in the area? What were they trading at?
Yeah, they were all in the high 5s, low to mid 6s. Mm-hmm. But we just wanted to be conservative with the exit cap at least a point higher than what we were going to be appraised at.
Mm-hmm. Yeah. No, it's amazing what the cap rates are doing right now in these various markets at this stage in the cycle. So I think you guys got definitely bought it at a good cap rate, and looking forward to continue to follow you guys. I know you're not that far down the road from me. I'm just in Columbia, South Carolina, and you're in Greenville. We could probably drive 45 minutes in each direction and meet in Clinton. So it's not too far for us. Yeah. Well, I know you guys mentioned earlier on the podcast that you had acquired or you had put it under contract in May, but then, it didn't close until November because we said it closed November 18th. And I know, Brian, we've been kind of emailing back and forth, pushing this interview off a little bit because there have been a few little delays along the process. Was there anything outside of what we've already discussed that maybe you think might be interesting for us to kind of talk about or know about that kind of maybe came up throughout this process?
I think the main reason the timeline was dragged out was just having to get HUD's approval. So typically, they say it takes normally 60 days for them to give a preliminary approval, and then you would have 30 days to close after that. But it turned out taking 120 days. And, you can't tell the government to hurry up. So we were a little bit at the mercy of them. So it was just kind of a hurry up and wait process, all summer really and into the fall.
Yeah, and I think
I thought Brian was going to say something. Go ahead.
Yeah, just to add to that, I think one lesson learned, I guess, would be with any deal that you're going to put together, whether it's a syndication, real estate deal, whatever, you've got to be on top of things, right? You've got to constantly be the quarterback that's making sure everyone's talking, everyone's saying the same things, and that you're meeting deadlines and that you're doing all the right paperwork. I think this one was just that on steroids, right? And it was also elongated. I mean, Brian took the brunt of this over the past 6 months, just making sure that everyone was talking and everyone was on the same page with approvals and documentation and requirements and so forth. So it's not for the faint of heart when it comes to folks that maybe aren't as organized or, on top of it. You really have to step up your game and the organizational administrative side of things. Because if you don't, stuff's going to fall through the cracks and you're going to pay for it later, or you're just not going to get the deal done and you're going to waste 6 months of your time and effort, which we're glad that wasn't the case here.
Well, I think that also goes to the story of, getting a larger equity split, but also even a higher acquisition fee than what we might normally see. I think that's a great idea because I think you guys had, was it a 3% acquisition fee?
That's right.
Yeah. So being a smaller property and a lot more work along the process definitely makes sense to have that higher acquisition fee. And that's one thing I always say is that, the smaller the deal, the higher that acquisition fee has to be able to kind of still compensate in a similar fashion for the same level of work and effort that it takes to close those smaller deals as it does a larger deal. So there's got to be some sort of equitable exchange there.
Yeah, we definitely feel like we earned it on this one.
Well, you guys will when you go full cycle with us, so that'll be great. Or even as you continue to hold it and cash flow it, so that'll be good to kind of see. Well, I have two final questions, and either one of you can answer these two questions. They're kind of contrasting questions. The first one is, what did you find easy during this entire process? That I'm kind of laughing because I'm not sure if anything was easy on this process with this one, but what did you find that was easy during this entire process and this acquisition that maybe in the beginning you thought was going to be a little bit harder?
I'll be happy to take that one. Yeah. I think it was raising the money from the investors. Like Brian said, we were fully committed within 48 hours, and this being only my second fundraise and the first one being half the size of this one, I was a little apprehensive on how long it would take us to fill the quota, but when it got filled quickly, that was wonderful news.
That's exciting. Well,
yeah, I would say maybe something a little bit different. I think if you just looked at this deal on paper, or someone told it to you in 10 seconds, and you heard, it's 80 units, it's in the Clinton market, South Carolina, it's government subsidized housing, I think immediately you have a lot of red flags go off in terms of, oh my gosh, this is going to be complicated, it's going to be a lot of work and all that. And there's no doubt there was a lot of work, but it's a great property. It's on a nice piece of 10-acre land. It's got, the buildings are in great shape. The tenant base is strong. And so a lot of those sort of preconceived notions I don't think fully came true during the due diligence. It's a great asset. It's being run by professional, when we bought it, and we'll continue to run it in a professional manner. And overall, I think it's exceeded our expectations that maybe were lower when we first heard about the deal.
What did you guys do in the beginning to kind of follow up with that response? What did you guys do in the beginning to maybe fix your mindset around some of those red flags that probably popped up in your head as well? That which is what it pops up in a lot of people's heads. What did you guys do to kind of still go down the path of investigating this property and then eventually touring it and then actually putting an offer on it? Because I think you're right, Brian, that there are a lot of people that look at that, myself included, 80 units, Clinton, government is subsidized. I don't want to look at it anymore. Red flags are going up all over the place. What did you guys do to kind of mitigate that mindset for yourself?
You just got to take it one step at a time, and it doesn't excuse you from doing all of your normal due diligence plus more, and really just taking it as it comes. I mean, that's one of the reasons that we weren't chosen in the beginning is we didn't have that sort of, large HUD experience as the other buyers that fell out of contract. And so it wasn't any news to anyone that we were quote unquote newbies to this new world of HUD. So as long as you keep your head on straight and you march forward and take one step at a time, you still go through the same traditional process to close the deal through all the due diligence. You just have to make sure a couple other, paperwork and stuff is in good shape. So still go through your same process. Don't, pretend like you have to not do anything because of the particulars of the project.
Yeah, I agree with that.
The last question I have for you before we wrap things up here is the opposite of that question that I just asked you is what did you find that was harder than expected that maybe in the beginning you thought was going to be a little bit easier?
I never thought getting through the HUD process was going to be easy, but it turned out to be harder than I anticipated. And there were just some last minute curveballs that came up, like the ADA compliance. There was a few days there where I thought we were going to have to do an additional $60,000 of renovations to the property because of what ADA compliance might have been. But it turned out that we found ways to get grandfathered in under some of those rules. But it took a lot of phone calls to different experts in the field on that kind of thing to make sure we were right on that point.
So it was that was something that you thought was going to be hard in the beginning, but it ended up being harder than you thought it was going to be hard. So no, I think I would definitely, after hearing your story here, would say that as well. But I bet the next deal you see that has a HUD or a HAP contract on it, you're going to probably go into it eyes wide open because you already know what to expect, and it'll probably be a little bit easier for you, even though it'll still be difficult.
That's right. You just got to build in some timelines into the contract that give you the opportunity to do everything you need to do, and are contingent on HUD, right? Like the clock doesn't start ticking on certain timelines until they satisfy what they have to do.
Yeah. Well, and I would assume that as a HUD seller, they would understand that process and that timeline as well. So when you guys go to eventually exit this property, there's going to probably be that same leeway that you're going to have to give that new buyer of having those additional timings inside of that contract as well.
That's right. I highly credit the seller for helping us through this project, being flexible. We really could not have closed it without their help. They were instrumental in the whole process of applying to HUD, guiding me on exactly how to fill out certain forms. So it definitely takes a willing seller to get it across the finish line with something like this.
Yeah. Well, good. Well, Brian, how can the listeners reach out to you if they have further questions for you about this particular project or maybe some of your future opportunities that you have coming up here in the future?
Yeah, my email is Brian, BRIAN, at affordableupstate.com. It's AFFORDABLEUPSTATE.com. And our website's affordableupstate.com as well.
Awesome. Awesome. Well, great. Well, thank you guys both so much for being here and sharing some information about and some insights about this particular acquisition in Clinton, South Carolina. I wish you guys the very best on it and looking forward to continuing to follow you on this acquisition, but also continuing to follow you on some of your future acquisitions and maybe even having you on a future episode as you continue to close more deals.
Thanks, Dan. This was fun.
That'd be great. Thanks. Appreciate it.